Are you new to investing and feeling overwhelmed? Don't worry, you're not alone. Investing can seem intimidating at first, but it doesn't have to be. Hi, my name is Mike, and in this video I'll go over some of the basics when it comes to investing. I will also provide some tips to help you get started on your investing journey. If you like this video, don't forget to like and subscribe. First, let's define investing. Investing is the act of putting your money into assets with the expectation of earning a financial return. There are many different types of investments, including stocks, bonds, mutual funds, and real estate. So, why should you invest? Investing can help you grow your wealth over time and achieve your financial goals, such as saving for retirement or buying a home. It's important to start investing as early as possible to take advantage of compound interest, which is the interest that you earn on your investments as well as the interest earned on the previous interest. Now that you know why investing is important, let's talk about how to get started. Step 1 is all about figuring out what you want to do with your money. Do you want to save it up for a special toy or a trip to the beach? Or maybe you want to save it for when you grow up and want to buy a house or a car. Whatever it is, it's important to think about what you want to do with your money so you can decide the best way to save it and make it grow. This is called setting a goal. Setting a goal will help you figure out how much money you need to save and how long you have to save it, which will help you choose the right investments for you. Step 2 is about how brave you are with your money. Some people like to take big risks with their money because they hope to earn a lot of money back. This can be a little scary, but sometimes it pays off. Other people like to play it safe with their money and don't want to take too many risks. They might earn a little less money, but they also won't lose as much if something goes wrong. This is called your risk tolerance. It's important to think about how much risk you are comfortable taking with your money when you are deciding what to do with it. Your risk tolerance will help you choose investments that are suitable for you and your financial goals. Step 3 is about how much time you have to save and grow your money. If you have a long time, like 10 or 20 years, you have more time to let your money grow and you can take a little more risk with it. But if you don't have as much time, like only a year or two, you might want to be a little safer with your money so you don't lose it. This is called your time horizon. It's important to think about your time horizon when you are deciding what to do with your money because it can help you choose the right investments for you. For example, if you have a long time horizon and are comfortable taking on more risk, you may want to consider investments like stocks, which have the potential for higher returns but also carry more risk. If you have a short time horizon and want to play it safe, you may want to consider investments like bonds, which tend to have lower returns but also lower risk. Step 4 is about figuring out how much money you have to invest. It's important to have an idea of how much money you can afford to invest so you can create a budget and determine the size of your portfolio. Your portfolio is the collection of investments you own. To determine how much money you have to invest, start by adding up all of your income and subtracting your fixed expenses, like rent or mortgage payments and car payments. This will give you an idea of how much money you have left over to invest. Keep in mind that it's generally recommended to have an emergency fund equal to at least 3 to 6 months of living expenses in case of unexpected expenses or income disruptions. Step 5 is about choosing a place to keep your investments. There are several types of investment accounts to choose from, each with its own set of rules and tax implications. Some common types of investment accounts include individual brokerage accounts. These are accounts that you can open at a brokerage firm, like a bank or online broker. You can buy and sell a wide variety of investments, such as stocks, bonds, and mutual funds, through a brokerage account. Employer-sponsored 401k plans. Many employers offer 401k plans, which are tax-advantaged retirement savings accounts. If your employer offers a 401k plan, you may be able to contribute a portion of your salary to the plan and your employer may also make contributions on your behalf. IRAs. Individual retirement accounts, or IRAs, are another type of tax-advantaged account designed for saving for retirement. There are several types of IRAs to choose from, including traditional IRAs and Roth IRAs. It's important to understand the differences between these types of accounts and choose the one that is right for your financial situation and goals. You may want to consult with a financial professional for guidance on which account is best for you. Step 6 is about choosing the actual investments for your portfolio. There are many different types of investments to choose from, including stocks, bonds, mutual funds, and exchange-traded funds, ETFs. It's important to do your research and carefully consider your investment goals, risk tolerance, and time horizon when selecting your investments. Stocks are ownership shares in a company. When you buy a stock, you become a shareholder and are entitled to a portion of the company's profits. Stocks can be volatile, meaning their value can go up and down a lot, but they also have the potential for high returns. Bonds are loans that you make to a company or government. In exchange for lending your money, the borrower agrees to pay you back the principal, plus interest, at a later date. Bonds tend to be less risky than stocks but also have lower returns. Mutual funds are investment vehicles that pool together money from many investors and invest in a diversified portfolio of stocks, bonds, or other securities. Mutual funds offer professional management and diversification, but they also come with management fees. Exchange-traded funds, ETFs, are similar to mutual funds, but they are traded on stock exchanges and have lower management. Step 7 is about keeping track of your investments and making sure they are still aligned with your goals. It's important to regularly review your investments to ensure that they are performing as expected and to make sure they are still suitable for your risk tolerance and time horizon. If your circumstances or investment goals have changed, you may need to make adjustments to your portfolio. It's also a good idea to periodically rebalance your portfolio to maintain the desired asset allocation. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and cash, in order to manage risk and optimize returns. Over time, the value of your investments may shift, causing your asset allocation to become unbalanced. Rebalancing involves selling some of the investments that have increased in value and buying more of the investments that have decreased in value, in order to bring your portfolio back to its desired asset allocation. By monitoring and reviewing your investments regularly, you can make sure that they are on track to meet your financial goals. That's it. By following these steps, you'll be well on your way to becoming a successful investor. Remember, investing involves risk and there is no guarantee of a financial return. It's important to do your due diligence and consult with a financial professional if you have any questions. Thanks for watching. We hope this video has helped you understand the basics of investing. If you have some thoughts regarding investing, or tips that others should know, don't hesitate to comment down below. Happy investing!